Let's bring in Lori Calvasina, RBC Capital Markets, head of U.S. equity strategy. Lori, great to see you.
Good to see you.
Coming in. What's your sense of where the market is on what it's already essentially taking credit for in terms of the trade front and what happens to growth as a result?
So, look, I've been on the road talking to clients the last 2 weeks and started out the day after that de-escalation in China and the U.S. And, to be honest, based on my valuation work, I feel like we went ahead and priced in the economic improvement and the improvement in the inflation outlook that portends in a day. And we've been sort of hovering around, kind of the recent highs, kind of bobbing up and down a little bit. My valuation modeling says 57.30 is fair value. If you use consensus earnings instead of my earnings, you'll get to about 58.84. So that's telling me we kind of put it in already.
So like 1 to 3% down from where we are right now, is kind of how the work brings you in.
Exactly. And, I've got a couple of models. I use 5 models in my targeting process for the S&P. My valuation and earnings work is the median. So we went with that with the target revamp we did this morning. My sentiment model can certainly get you up to around 6,400 on the S&P, and that's plausible. But my GDP test also tells you to look for something between 56 and 5,700. And that's the idea that the stock market doesn't do well when economic growth is in the sluggish zone, which is in kind of the 1 to 2% type range. Consensus forecast for around 1.4% right now. So there's a big hurdle to get back to that 2% mark, which is where stocks tend to be really healthy.
So what's your read then on how far the market has been able to travel to this point? Is it just kind of, we re-engage with the AI trade and we're sort of continuing to enjoy this period when the economic data has not really eroded yet?
So, what we did on April 8th was we priced in a growth scare, which was a recession near miss or big systemic breakdown. And if you look at the distance we've traveled, that 20% is within range of the rebounds off of prior growth scares or 10% drawdowns in the post-GFC period. So we actually did a big study of that. And the rebounds, at the, kind of on a 9-month basis tend to range from 17% to 35%. So, we're kind of right smack in the middle of that range. I do think that investor interest in kind of rotating out of the U.S. took a little bit of a pause. We saw a lot of that in March. It kind of took a breather. I think that's helped, and I think that's also reinvigorated the Mag 7 trade. The other thing, Mike, that's really fascinating is the rate of upward revisions on the biggest market cap names in the S&P fell to like 15% in April, and that's on par with crisis lows, and we've seen some relief there. But I think you got a lot of earnings angst out of the way, and maybe there's been a calm down on that AI trade as well.
How much of a spread is there between where you think earnings are going to go and consensus at this point?
So my modeling is at 258. The consensus bottom up, when I checked it late last week, it was at 264. And that's been pretty stable.
About 2 months it's been around that level.
Right. It came down. It was at 275 at one point. It was hovering around 271, and now it's taken that step down. And what I've got baked into my modeling is, we've got 3 cuts from the Fed starting in September, inflation in the upper 2s. None of that is terribly controversial versus consensus. We've also got GDP, again, kind of 1.3% type number. What we're really doing that's a little bit different is we've got margins contracting a little bit on a year-over-year basis if you look at the second half of the year. And we've modeled that on what we saw similar to the kind of late 2018 type period. We've got a little bit of margin hit in the second quarter, and I think that's where there's probably some difference.
I hear people pointing to things like, credit spreads have come back in. They're really not at particularly worrisome levels. Industrials as a sector made new highs. They continue to outperform. Now, would it be smart to pull a macro message out of that and be reassured, or do you think there are other things happening?
I think it's hard to read the tea leaves in high yield if you're comparing it to history. This is not my area of expertise, but when I talk to folks on that side of the business, what they tell me is the balance sheets have been cleaned up there as well, so it's not, your mother's high yield sector. And that's certainly, to be honest, how we feel about small caps, except that has taken on quite a bit more pain. If I think about industrials, I'll tell you, I'm neutral this sector. It's ridiculously overvalued. It's like 3 standard deviations on my model, both absolute and relative PEs. But the one thing I'll give the sector is that as we've gone through and looked at transcripts and the ability to manage through tariffs, they sound very confident. You contrast that with the consumer sectors, not so confident. They're not quite so sure they can pass on pricing. They might be having more margin pressures. Industrials seem like they've been there, done that, and they've got it under control.